Hello, and welcome to the 11th episode of the Market Pulse series. My name is Rufas Kamau, Markets Analyst at FX Pesa. So before we make any progress, I would like to wish you happy holidays. This is the last episode we are doing for the year, so we'll kick off with a complete new series getting into next year. So thank you very much for joining the session. If you have any questions, comments, kindly feel free to type that the live comment section, and these will help me understand whether you're getting the content and how to respond to that. So once you join, kindly type hi on the live comment section, and these will tell me that everything is working just fine. All right, let's get this started. So today's topic is quite simple. We know that the markets are largely quiet. There's nothing much or big happening in the economic calendar. The earnings have all gone mute. We're not expecting a lot of impact in the markets this week. So a lot of impact is expected from next week once we begin the new year. So in today's presentation, the topic is very simple. We'll be looking at what to do if you keep losing money in your trading. So I know it's quite a big challenge for a majority of us, where you begin trading, let's say in your first week, first month, you find that you're losing money, you put more effort, do more learning, you deposit money again, you lose. So I want to go through this process, help you understand what could be wrong, how you could address that, and how you could get back on track. So we'll be focusing on a couple of things. One of them is how to identify your personal trading mistakes. Two, we look at how to self-diagnose your trading strategy. Three, we look at rethinking the entire trading process. Four, rebuilding your risk management plan. And five, starting over. So once we cover these 5 different topics, then it will be a good session for everyone that is attending. So hopefully you get to gain value from this. And hello, Kelvin. Hello, Ali. Hello, Tony. Hello, Annette. Hello, Willie. Thank you, guys. Thank you for joining the session. Let's proceed with this. So the very first thing that we need to notice is that if you keep losing money in your trading, then you have to take responsibility. So if you don't deposit money in your trading account, and if you don't trade at all, then you never lose money in the markets. So it's your own personal decisions that eventually lead to the loss. So you have to take full responsibility of your trading decisions. So once you get this done, then the next step is to accept what the market is and the full nature of the markets. So this is one thing that I will always tell my students. So whenever you join the markets and you begin trading, you have to accept a couple of things. One is that the market obeys no rules. There are no rules for the market. You can do what it wants at any given time. Even though we trade statistical patterns or repeating patterns, there is no way of telling with certainty that the market will absolutely move to this direction, to this point, or so whatsoever. So you have to accept that reality about the market. There are no rules that determine how the markets move. So once you understand that, the next part to understand is that whether you execute a trade, remember we are retail traders, we trade a very small amount. So whether you execute a trade in gold, in Euro USD, in oil, or whatever asset you trade, know that the market could have done the same thing with or without you. So whether you participated in the market or you didn't, the market would have moved in the same exact way. So this removes the emotional connection in the market or the sentimental connection where you feel like the market is rewarding you, the market is punishing you. No. Whether you are in the market or not, the market would still have done the same thing. The way I want you to think about this is, let's say you're betting on a game between Arsenal and Manchester United. So if you bet whether Arsenal or Manchester United will win, you have absolutely no influence on the game. So whether you pressed your bet or not, the outcome of the game would still have been the same exact outcome. So this means that your decision to invest in that particular market rise squarely on you. So you take full responsibility of the risks that you have taken in that particular market. So now that you've covered the second point about the market, the third one, and I think this is the most important one, is that the market can move in any direction at any given time by any number of pips. So at any given period, as long as the market is open, the price can jump up, it can jump downwards, it can also do both. It can spike up and then back down within a couple of seconds. And within that period, you will have made out of money or lost out of money. So that's the insane or the crazy reality about the market. They can move in any direction by any number of pips at any given time. So even if you do your analysis and you find the average movement, let's say you trade Euro USD, moves 400 pips every day, and then you'll notice sometimes it's 300, sometimes it's 200, sometimes it's 500, sometimes it's even 1,000 pips and so on. So those movements can have an average. You can have a mental expectation that gold moves this number of pips on an average day, but that does not limit the market from doing what it does, which means you have to accept the full responsibility that the market can spike by any number of pips in any direction at any given time. And now that we understand how the basics about the markets and how it functions, the next thing to think about is trading mistakes. So as a beginner, if you deposit money in your trading account, let's say you start with $1,000, one of the key mistakes that you make is mostly on education. The fact that most beginner traders learn from successful traders or online, I see other guys are trading out there, they're making more money, they're making millions. And then you decide maybe I should also try this out to deposit money and start trading. You focus more on the money and then you leave the education part aside. It is very important that when you begin your trading career, you focus on investing your time in learning fast. So you can do this by following some of my lessons. You can do other content out there to study, understand how the markets work, practice those ideas on a demo account, build confidence and skill before you trade in a real account. So that's the number one mistake that traders make, and this is not going through education fast. So the other common mistake that beginners make is that the moment you deposit your first money, there's this very common thing that I've experienced over and over with many traders that I've trained in the years, and this is called beginner's luck. So you deposit your first amount, this could be $1,000, and then you trade for a while, you double that amount, get 2,000 and 3,000, and then you get overconfident. So overconfidence kills so many careers in trading. You realize that you started small. I took my advice. I started trading very small lot sizes. Let's say you are doing 0.01, 0.02. I do a swing or a couple of trades that are successful. Those trades give you some good rewards. And then immediately after you've doubled or tripled your account, the next thing you realize that the trader becomes overconfident. And then they start trading even bigger lot sizes. And this can really mess up your mind. When you just deposit money in your account, in a couple of days or weeks, you have doubled or tripled that account, it will mess up your mind. So you will think that people make very easy money in trading, and then you loosen your risk management plan. So that's when you start taking even more risk and then end up blowing your account. So it's a mistake that I used to do in my early days, and I know it probably has affected some of you guys. So as we proceed with the session, I would like to get some input from you guys. What are some of the biggest mistakes you encountered once you started trading on a live account? Once you get to understand these, then you can share even more content and then try to digest this information to something that can be used by another beginner trader who has not yet understood the mistakes they are making. So there's a good question here from Cherry Genius. Hey, so the market follows order flow? Absolutely. That's how the markets work. they follow the laws of demand and supply. If more traders in the market are buying, then that demand will drive prices higher. And if more traders are selling, then that will drive prices lower. So that's the unique nature of the market, demand and supply. And whenever we're doing our analysis, we are always trying to analyze that order flow, whether be it technical, sentimental, or even fundamental analysis. So when you're doing, let's say, fundamental analysis, you're trying to understand what is influencing the participants in the market. So if there's some piece of news that is, let's say, negative for Tesla, then that news is going to turn into action, and the participants in the market will sell, increase the supply in the market, and push prices down. So everything narrows down to order flow or the demand and supply in the market. So hello, Albert. Welcome to the session. I want to get some feedback from you guys. What are the simple beginner mistakes that you used to do, or the ones that you are doing currently that you need us to address in this particular session? Once we get this feedback, then it will be easy, digest, and basically build a solution for everyone so that you're able to become consistently profitable trading in the markets. So we have already identified one key problem, and this is overconfidence. We have mentioned the lack of education. Another key thing is having being a master of everything. So this is quite common. You go through the baby tips course, you do another YouTube course, you're on Twitter, you're following other traders on Twitter, and every time there's a trading idea, you jump right into it. You're not going to be successful trading in the markets with 15, 20 strategies. You just need one, and these will serve you well. So if you find yourself trading all kinds of setups in the markets, then you might probably not be able to become consistently profitable. So you need to identify an edge, and an edge is basically an advantage that you have before you execute your trade. Once you get that edge, then it becomes easy to repeat that edge consistently, and over time, the law of numbers will basically serve you right. So thank you, David Ochieng, overconfidence. I know this is quite big. So another common mistake that we normally get is projecting our insecurities to our trading account. So sometimes you are trading and you are stretched by your budget, and you need to get something done. For instance, let's say next week you're looking to pay school fees, you don't have that money, and you're trying to squeeze that money out of the market. So once you identify a very usual and a very normal trading opportunity, where let's say you basically risk $100, targeting to make $300, $400, you want to make all that money within one home run, one move. So you identify a really good trade, and then you put everything into it. I've seen traders do this. They become so overconfident, and then they risk too much in one trade. And then what often happens is that since they have taken such a huge trade, let's say you normally trade 0.1, now you decide to trade one full lot. So in this case, you're looking to make a lot of money from one trading set. So when the market happens to go against you and you don't make that home run, so instead of acknowledging that they were wrong and cut losses, they develop that resistance to avoid making or taking that loss. So I've seen some traders execute a trade in the opposite direction, saying this is hedging. I wouldn't call that hedging. You're basically locking yourself into a losing position. So they refuse to close the trade. So some of them will let it run until it ruins their entire account. Others will lock in into a loss position, and they will be left with a very small margin. Then they will try to get out, and eventually they will lose that account. So those are some of the challenges that traders get to experience. So the number one way of making sure that you're not consistently losing in the markets is by having a properly well-written down risk management plan and following that plan religiously, as if your life depends on it. So once you do that, then it becomes easy to trade consistently and be profitable in your trading. So if you normally risk $30 per trade, then you should never change that unless something happens that is in your trading plan. So if in your trading plan, it says when your account gets to this level, then adjust your risk appetite from $30 to $50, then you basically follow that. So if you don't have a plan, then you probably fail. So make sure that you have a plan for that. So I'm getting some responses here. So losing a trade and thinking maybe trading is not your thing. Yes, yes. This is a good point. So sometimes you execute a trade that you have well researched, you've been patiently waiting for that trade. And then once you execute your trade, the trade moves straight for your stop loss and you start thinking, oh, this is not the right thing for me. Maybe I should do something else. And then you lose all hope in trading. So that's not supposed to be how it works. So when it comes to trading, remember, this is a game of probabilities. So when you're playing this game, you know that you're working with probabilities and that any trade can yield either side of the probability, either a win or a loss. So you are supposed to accept the risk taking in terms of the amount. For instance, if you deposit $1,000 and you decide to risk $30, by the time you're executing that trade, you should fully accept that you could lose that $30 and mentally adjust your trading balance to 970. So these will keep you sane and you will have the right mental attitude when you are taking the next trade. On the other hand, since the game of probabilities, having an edge is only one thing. The other thing is understanding how these probabilities work. So you need to execute high probability trades consistently, and the outcome of those trades is random. So you're not going to get a consistent outcome from those trades. So you're not going to get wins, and never lose. You're not going to get loss, and never win. So what actually happens, you'll have a mix of both. You have wins and losses in between. The distribution of those wins and losses is random. So sometimes it will be win, and then loss, win, loss, and then win, loss, and so on. So once you play that over a large number of trades, if your trading strategy has a good edge and a good risk-reward ratio, then overall you find yourself in a winning position. So that's how we play the game. Even the most professional traders, the most experienced traders, we still get wins and losses in between, but the outcome after a large number of trades, say 20, 50 trades, is often a winning balance. You have a winning profit. So the way you do this is by understanding that the outcome of one individual trade doesn't matter. The outcome of a collection of trades is what matters. So once you focus on the overall longer run and bigger number of trades, then it becomes easy to fully accept a loss of one trade and move on to the next without pegging the judgment of the next trade on the previous trade. So each trade is mutually exclusive, has no relationship whatsoever with the next trade. So getting also more content here. So impatient and taking trades in the wrong direction, having correct analysis. This is good. So sometimes you can be impatient, and this is something that you can easily resolve. So if you find yourself impatient, where either you are entering or exiting trade earlier than projected, then you can always solve this with a plan. So have a plan that clearly demonstrates when all the conditions for entry and the conditions for exit, as well as the conditions for adjusting your stop loss. So once you have those written down, then you'll never be impatient when executing your trades. So there's also another common mistake that I find with beginner traders. So whenever you execute a trade or a couple of trades, you're much more comfortable when they are in the red, that is, they're on the losing side. But the moment they turn green, you get excited and you want to cash out that money. That is not supposed to be the way it works. So you are supposed to be more comfortable with trades that are running in the green and less comfortable with the trades that are running in the red. So if you have a couple of trades, let's say you have 5 trades running, and they're all in the green, you should be more comfortable. If they're all in the red, then you should be very uncomfortable looking to cut your losses short. So most traders will let their losses run, and they will have big negative balances. And then when the trades turn into the green, instead of holding on and waiting for the profits to get bigger, they normally cut those profits short. And that's not supposed to be the way it works. So you're supposed to change that line of thinking and be more comfortable with having a winning trade. That's how you build a winning mentality. So good responses. For those who are joining late, you should know we are looking at how to stop yourself from losing money in the markets. So if you have any challenges you've been experiencing as a beginner trader, kindly type them in the live comment section and we address that as we move forward. So a good question, does FX Pesa benefit from traders losing? No, we don't. We make money from commissions and spreads. So if you stop trading, you start trading, you lose money and you stop trading, then it's not serving us. So the best way that to keep our business going forward is to make sure that you guys are making more and more money, trading bigger and bigger accounts. This way we get bigger and bigger commissions and spreads. So if you're not trading, then we are not in business. So it is in our line of interest to make sure that you are successful so that we can also be successful. So the interests are aligned in this case. So also good comment from Kelvin. Having a small account that cannot provide enough margin, this makes you worry about growing your account, heading to pretty much where it is. This is a very good comment. I think it's one of the challenges that I've been facing with a lot of traders here. So if you're a beginner trader and you decide to start small, don't start with $10. $10 doesn't give you enough room to recover in case you take a hit of 1 or 2 losses. You'll be more worried about your account growing, and you'll not be focused more on the process, you'll be focused more on the money. So remember, the thing is you want to focus more on the process and the money will come in later. So the idea of having small trades building up in your trading strategy is to distribute your risk across different trades. So if, for instance, you deposit $1,000 and you decide to take risks of, let's say, $10 per trade, then you have an outlay of 100 possible trades. So if you have a trading system that has a good edge, then you can execute your first trade, the second trade, the third trade, and even if the first 3 trades are losing, you still have sufficient capital to keep on going. You'll still have $970 or basically 97 more trades, and you'll keep on playing those trades over and over again. And once the probabilities play out, then you'll find that you have a winning outcome over a period of time. However, if you start with a very small account, let's say $10, and you decide to risk $3 in your first trade, you lose. At the end of the next trade, you lose another $3. Now you have 6 trades, $6, sorry. You have $4 remaining, and now it's almost even hard to execute that trade. So starting with a very small balance can also be your number one enemy. So if you're a beginner and let's say you are tied up in terms of cash, you don't have sufficient cash to start with $1,000 or even over, then at least start with a balance of, let's say, $100. $100, if you're risking $5 per trade, then you'll have an outlay of 20 trades. If you are doing even smaller than that, let's say $3, $2.5, then you have a larger number of trades, you're able to distribute your risk across different trades. However, if you start with a very small balance, then your chances of survival are minimal. So if you just started with $5 in your trading account, then it's probably maybe just to test whether a live trade works and see how it performs. But if you're serious about your trading, then you need to distribute your risk across different trades. And this means starting with a much bigger balance. So let's get to see all the other questions that you guys are raising and comments, and they are much more welcome. So discuss about the importance of leverage and where to apply small and large leverage. So when it comes to leverage, this is money that your broker provides you. You don't have to take on a bigger position even if you have a small account balance. So for instance, the maximum leverage that FX Pesa offers is 400:1, meaning that you can take a position that is 400 times bigger than your account size. However, when it comes to taking on leverage, it's a decision that you make every time you're entering a trade, and you make this decision by determining the lot size. So let me try and demonstrate this. So this is a chart of gold, and as you can see, it has been moving up for the day, currently at this price level here. So if you decide to execute a trade here, okay, let me close this. So you go to new order, and then you determine the lot size here under volume. So if you trade the minimum, which is 0.01, let's say we go for a short selling trade, notice that every 29 points are equivalent to $0.29. So this is the lowest leverage that you can take in your trading position. So the amount of leverage you take per trade is determined by the lot size that you trade. So in this case, every time the market moves by a point, then you make or lose $0.01. So if it moves by 1,000 points, then you'll be making $10 or losing $10. So this makes sure that you have the least exposure in that particular asset. So if I close this, notice that 7 points is equivalent to $0.37. So let's close this and now take a much bigger leverage. So in this case, instead of trading the minimum, trade a much bigger size. Let's say you trade one full lot. So we go for the same trade again. And now notice that by being negative 8 points is equivalent to negative $8. So negative 19 points, negative $19, negative 30 points, $30, and so on. So this time, every time the market moves by a point, you are either making or losing a full dollar. So in the previous example, you are either making or losing 0.01 of a dollar, or basically 1 cent. So now you have bought a much bigger volume. So every time the price moves by a small point, then the effect on the trading account is much bigger. So that's how you basically determine whether the market moves. How much market movements affect you. So if you're taking a much bigger position, then the risk is higher and also the reward is potentially higher. So if you have a small account, I always advise to trade the minimum lot size until you understand what you're doing. So you basically trade 0.01 lots. And once you are comfortable with the markets and you have a much bigger balance, then you can decide a much bigger lot size, and that would be done once you have the skill and the confidence in the markets. So thank you, Grace, for the question. Thank you guys for your questions and comments, feedback. So as mentioned, we'll be covering quite a number of things. So what to do if you keep losing money in trading, how to identify personal trading mistakes. Another key thing is through social or community trading, where you get to share with other traders, understand what they are doing right, what they are doing wrong, and how they have done and resolved these mistakes. So if you're a part of a community, it's very important that you get to share an experience with them, ask them questions, try to understand what they are doing, how they are doing it, and how they are handling those challenges. So most of the mistakes you're going to be doing in your beginner trading journey have already been made by other person, and a solution already exists for that. So in that case, it means that if you're able to speak with other traders, then you can identify those mistakes. And once you identify those mistakes, then you're able to resolve and become a much better trader. So I've just shared a link to my personal. This is not the company's group. This is my personal Telegram group. Here you can meet other traders, raise questions, share your challenges, and we'll give you the feedback and help you advance forward. So that's one of the things that you can use to solve some of these challenges as a beginner. So another challenge is borrowing money to invest or to trade. So if you borrow money to trade, then you have expectations. You need to repay that money. You don't want to lose that money in the market. So it's not easy for you to fully accept the risks that you're taking in the markets. So avoid trading on borrowed money at all costs. So remember, besides the leverage you're taking, you're also borrowing money from somewhere else. So only invest the amount of money that you don't need today, and the amount of money that you don't need tomorrow, or even the next month. So if you had some savings in the bank that you are, let's say, looking to use in the next 3, 4, 5 years, then that's money that you can trade and invest in. However, if you have some money in the bank and you need this money to pay school fees next month, to pay house rent, to pay some bills in the near future, then you should not trade that money. So only trade the money that you can afford to lose. So this way you'll have lesser weight on emotions. There will be less expectations of that money. This way you'll be able to focus more on the process rather than the outcome of individual trades. So that's one advice that has served me well over the years. So besides this, if you have a secondary job or source of income, this is a big, big plus for any trader out there. So I know there's a lot of traders who do this full time, but if you have a secondary source of income, an income that handles your other bills, then you'll be more patient with the market, you'll be more focused on the process, and this will serve you right. So if you have a job and you're looking to go full-time trading, perhaps try to develop a mix of both, where you are working that job or gig, while at the same time you're also trading. So these will help serve you right. So I know we've made much progress today, but there's one point that we almost missed. And this is the point regarding stop loss. So I know there's out of our traders out there and trainers, fake trainers, marketers out there telling you that they don't use stop loss. So I've not seen one trader in my 9-year trading career who has been successful trading without using a stop loss. So it doesn't happen. It's a lie. As long as you're trading a margin account, it's very important that you have a stop loss for your trades. So it's synonymous to, let's say, depositing your entire fund in a betting company and then betting the entire fund in one game. So if the outcome of that game goes against you, then you lose all your money. So every time you trade with a stop loss, you're exposing yourself to a fact that I mentioned at the beginning of the session. And this fact is very simple, that the market can move by any number of pips in any direction at any given time. So if you execute a trade and you don't set a stop loss, it means that if the market moves in the direction that you do not wish for and keeps on going, then you literally wipe off your account and you'll be left with zero balance. And you don't want that to happen. So just an example here. Let's say you go for a trade here. Let's say you are trading 0.1 lots. And then you execute your trade. So in this case, it's a sell trade. So as you can see, if the market is moving above my trade by 45 points, I'm down $4.5. So if it keeps on going up higher and higher, and this is not something that cannot happen, it can happen. Then notice that if the price keeps on going up higher and higher, then the potential for losing more and more money keeps on increasing. So let's say I use the daily chart, and every day the market keeps going up. Let's say it goes all the way up to this point, then I'll be down $2,370. So if your account was, let's say, $1,000, $1,500, then you'd literally be wiped off just because you didn't have a stop loss. So it's very important that you have a stop loss in your trade, and a reasonable one for that matter. So if you're trying to avoid losses too much, and then you set your stop loss just very close to price, then you'll be wiped out by short-term volatility. So if you want to make very short-term trades and your stop losses are too tight, then you realize that the market will keep on hitting your stop prices every now and then, and you'll be losing more and more money. Your account will be bleeding, thinning out after every other trade. So you need to keep your stop loss within a reasonable level. So if you're on 1 minute chart and you set your stop loss just here, then there is a very high probability that this one candlestick could just spike, hit your stop loss, and maybe you are right and the market moves in the opposite direction. So avoid stop losses that are too close to the price. In that case, you avoid getting kicked out by market volatility. So these will serve you a long way in your trading journey. So I'm hoping that this information is valuable to everyone who is attending this particular session. So what are the rates for capital gains and your advice on where country to report? Capital gains tax is paid to the KRA, so it's self-reporting. So unfortunately, today we are focused on something else, so I can't dive much on that. So I'll be passing on a couple of points, and this will be the last part of the presentation today. So one, a big loss causes all sorts of inner conflict. So first of all, if you are just a beginner, you get a need for revenge. You need to revenge quickly and recover that money. So it's something that you need to deal with right away and make sure that you don't fall for these psychological bias. So you don't have to recover that money immediately. You can be patient and look for the right kind of trade and then execute that trade. And eventually you recover the losses that you had made earlier. So sometimes you get fear after you have lost money in a particular asset. You avoid trading that asset. You need to learn how to handle that: anger, frustration, self-hate, market hate, and all those emotions that come after a loss. So there's no way to trade with that. There's no way to trade with a clear head immediately after a big loss. So sometimes it's best just to leave your trading desk, go do some other stuff, give yourself some time to cool off. Once those emotions are over, then maybe you should come back to the markets with a much clear head and look for another opportunity. So there are more than 250 trading days in a year, and there's no rush to get back in there. There's always more time. The market will always be here. So just give yourself some time out before you come back and make it all back. So sometimes it's just about a few days. Maybe it was your biggest single loss ever, or even a life-altering loss. So in times when, let's say, you've lost money and you're facing some form of financial ruin, there isn't much that you can do. Once you've lost money, you've lost, and that's it. So don't trade until you have resolved that issue. You need to know what mistakes that you did and learn from them so that you don't repeat those mistakes again. And the best thing is to first take a break, stop trading. If you find yourself in a ditch, stop digging. So once you stop what you are doing wrong, then rethink the entire trading process. Maybe perhaps go through your trading plan again and make decisions that are improving that trading plan before getting back to trading. So don't trade with a massive debt over your head with the intentions of using it to abolish that debt. That's a lot of pressure and would lead you to a worse predicament. So it's very important that you trade without debt. So the other thing is excuses. Avoid excuses at all costs. Take full ownership of your trading mistakes. So sometimes you will find traders, they execute a trade goes against them, and then they blame the broker. So the broker doesn't interfere or participate in your trading activity. So what we offer is a trading platform that connects you to the market. And if you check all other brokers, you'll notice that the prices are moving in just about the same way. So no broker is interested in hunting your stop loss or making sure your trade doesn't take profit. The thing is, if you execute the right trade and the market moves in the right direction, then you're always going to make money. If it moves in the opposite direction, then you're going to lose money. And this is the same whether you participate in the market or not. So make sure that you mark those ones. The markets will still move in the same direction whether you participated or not. So in this case, avoid all those kinds of excuses. It was the NFP, the news, or whatever. Take personal responsibility of your trading decisions. Whether you use your research to identify an edge, sometimes even when you have a 99% probability of winning in a trade, the market just does what it does, and it could go against you and hit your stop loss. You have to fully accept that. So the other key thing is that you need to realign your focus. So in some time back, in my darker days in trading, I remember I had lost quite a big amount in trading. I took a break, tried to find some focus before getting back into the markets. And somehow I bumped into a very good book called Trading in the Zone by Mark Douglas. Went through the book, I discovered some of the mistakes that I was doing. And when I came back to trading, I was more confident. I understood more of what I was doing, my mental flow, and the process of trading within my mind before engaging in the next trade. So sometimes you just need to take a step back, read more books, cover some more content before getting back into the markets. And this can be really helpful. It can revamp your mind, rebuild your confidence, and also improve your skill when you get back to trading. So it's very important that you go back through your notes, see what you learned, learn from your mistakes, and also learn more from the mistakes and advice of others, and And then from there, when you want to come back to trading, find that you're more confident, you have a better skill level, and you know what to avoid. So another good question, how do you know that it is the right time to quit the market in case of losses? So the thing is, if the average amount that you make in a day is $70, if you lose those $70 in a day, then it's probably the right time to stop trading for the day. So if the average return on a day, let's say you have done a couple of trades, and you normally get a profit of $100 to $200, then if it happens that you have lost $200 in a day, then it's probably the right time to exit. So the best way to resolve these is to determine those decisions beforehand. So in your trading plan, you should have a hard limit saying that if I lose this percent of my account in a day or even in a week, then I should stop trading and take a break. So once you have those rules written down, then it should become easy since you don't have to make an emotional decision. You're just following your plan, and if your plan says so, then you follow so. So the best way is to write this down beforehand. And thank you for the question, Body Boy. Apologies for that. So sometimes, if you need to reboost your confidence right after taking a break, you don't have to jump right in. You need to understand what's happening in the markets, rebuild your skill, analysis, trading, and so on. So a demo account is very important for a trader who is trying to get back in the game. So if you just found some money, you have been working to get some money to get back into trading, and now you have $5,000 redepositing in your account, don't jump right in and start trading. In fact, just deposit the money and then trade on a demo account. Trade a couple of sessions, you could trade a couple of days. So find good setups, execute them on your demo account, rebuild that confidence. Understand what's happening in the markets, what's the news, what has been moving the markets, what are the major trends, patterns, charts in the markets. Try them out on the demo account, and once you feel confident again, you understand that now my former self, the Rufas that was winning a month ago, and now you feel you're confident, now shift and get to the live trading account. So the other key thing, if you just deposited your $5,000 and you want to start trading again, you want to start small. You don't want to jump right into the big lot size that you are trading before your previous demise. You want to start small and rebuild that confidence over time. So if previously you are risking, let's say $20 or $50 or whatever amount that is, you might want to start small. Take the small win. Risk $10. Go through the trade. If it's a win, then risk another $10 or even move to 20. And then bit by bit, you get back into the game. So just like the way we work with a vehicle, if the vehicle you want to start a vehicle, you start with a low gear and then you keep progressing to a higher gear and then a higher gear. So don't just jump from 0 to 100. So just take the baby steps, be patient, know the market is not going anywhere. There's still enough time to make money in the markets. So just rebuild that confidence and focus on the process more than the money that you're making. And once you do that, then you'll be moving in the right direction. So that's it for today. I hope it was helpful. I hope you're able to draw some valuable insights in the presentation today. So if you have any questions, this is the time to raise the question before we end the session. Also, if you have any kind of feedback, it's also welcome. I welcome all kinds of feedback on the sessions. And also, I appreciate you guys for taking the time as well as participating in these sessions. All right, guys. So if there's no question, then thank you very much. This is the last session of the year. Hope next year we'll be doing even more. We'll create even more value. We'll do more market analysis. So we'll be focusing more on analyzing the market, looking for real advantage or real buyers in the market, looking for trading setups and trading opportunities, and together we grow and make money from these markets. So I almost forgot to mention that these particular sessions are meant to be purely educational. They're not investment advice nor any recommendation to trade. So you should make your own due diligence, do your own research before executing a trade in the markets.